Banks have been wobbling, tech stocks have been booming, and pharma has seen some companies thrive and others struggle. But which stocks could be overvalued or undervalued right now? Well, we've dived into the data to see what we can find. We're looking at companies in the S&P 500 that have a market cap of over $100 billion. The metric we'll use is the price-to-earnings ratio, which is commonly used to evaluate if a stock could be overvalued or undervalued. There are two types of PE ratios: the trailing PE, which divides the current share price by the earnings per share over the past 12 months, and the forward PE, which divides it with the expected future 12 months of earnings. One uses actual past data, the other uses expected future data, so comparing both could give a better picture.
You've got a forward price to earnings which is lower than a trailing price to earnings. It may essentially mean that analysts are expecting improving earnings in the future. So essentially you've got the same market current price, but you're dividing it by a higher denominator. So essentially your forward price to earnings will be lower than the trailing.
Right, let's jump into the data, starting with stocks that could be overvalued. IBM, a US software and cloud tech company, sits in 10th place with a PE of 67.68 after enjoying a healthy boost following the AI hype. 9th place is held by pharmaceutical giant Eli Lilly, whose PE of 73 comes after optimism for its weight management franchise saw a share price surge. In 8th place we have Tesla. Musk's EV company famously hit a PE of over 1,000 back in 2020, before crashing back down after a huge market sell-off. It now sits at almost 80 and has been steadily rising this year. 7th on our list is Intuitive Surgical, the market leader in the robotic surgery industry. Continued growth is projected, but do prices already reflect that? Warren Buffett's investing giant Berkshire Hathaway sits in 6th place. Its PE is approaching an all-time high of just over 100. Even as one of the greatest investors in history, this could be too high for some. Investment firm Blackstone occupies 5th with a PE of over 112, continuing the historic highs of 2023. Next to the AI boom, and we see a big jump. Leading chip makers Nvidia sits on our 4th spot with a PE of 219, while AMD is in 2nd place at 466. And in between them is cloud computing firm ServiceNow, who have devoted AI capabilities for their platforms. They have a PE of 285.
Given the expected growth within the industry, given the AI revolution, it is normal that trailing price to earnings are much higher than forward price to earnings because they haven't yet factored in the expected growth in earnings which are predicted for the semiconductor industry.
Finally, the company with the highest trading PE is another tech company involved with AI, Salesforce. This cloud-based software company sits at a whopping 550x, which makes it the most overvalued stock in terms of its price to earnings. But now let's see what happens if we look at the same shares, but this time using the forward PE ratio. Salesforce drops all the way back to 29, only bettered by Berkshire Hathaway, Blackstone, and IBM, while Tesla becomes the most overvalued share on the list at 78, followed by Intuitive Surgical and ServiceNow.
A trailing price to earnings that is higher than a forward price to earnings is actually good for a company. It essentially means that the fundamentals are improving and the stock is looking less and less overvalued and therefore more correctly priced. So in general, earnings forecast for the computer and technology sector, which Salesforce belongs to, have risen over the past few months, and therefore the increased expected earnings in the future have decreased the forward-looking price to earnings.
Before we continue, a reminder that here at Capital.com, we make explainer videos about trading and economics, giving you insights on the market so you can make informed trading decisions. We're also a trading platform, so you can make your trades right on our website or using our app. After this, check out our recent explainer on the price of defense stocks. We're now going to turn that metric on its head and use that PE ratio to find the most undervalued shares. Remember, this time we're looking for low numbers. Deere, the all-American tractor-making agricultural giant, takes the 10th spot, with both a trailing and forward PE of 13.66. Semiconductor and wireless technology firm Qualcomm comes in ninth, having experienced a downfall in performance in 2023, giving it a PE of 12.62. The next sector on our list might be good news for those who believe all might not be lost for the US banking system. Wells Fargo, Goldman Sachs, JP Morgan, and Bank of America take up the next 4 spots. Next, we have 2 oil giants, Chevron and ConocoPhillips, which both have a PE of 8.
Sectors where performance has decreased over the past few months, but earnings have remained stable or level with other industries will be looking undervalued. And by here, we're looking at financials, we're looking at energy companies, those companies that performed the best during 2022, whether that was because of the energy crisis, rolling off those pandemic highs, those companies that performed so well last year and have seen a devaluation in their stock price throughout 2023 are likely going to look undervalued in current price to earnings calculation.
ExxonMobil is actually drawn first place and is our joint most undervalued company by PE ratio, alongside big pharma's Pfizer. Pfizer enjoyed an enormous boost due to its COVID vaccine during the pandemic, but has steadily declined since. But how do those same shares look if we use the forward PE estimates? Pfizer is still the most undervalued share on the list, and Deere is still in 10th spot, while the 3 big petro companies look a little less undervalued. Across the 10 companies though, there isn't a great deal of change between the trailing and forward PE ratios, reflecting the low level of volatility the market is currently experiencing.
During times of extreme volatility, whether it is a rapid increase in market price, whether it is a frenzy, a potential bubble, whatever it may be, especially when we see price increase or decrease very rapidly, that's when we're going to see big shifts in trailing and forward-looking price to earnings. Usually earnings take longer to adapt, especially if we're looking at forward-looking earnings. So a lot of the time when we're seeing that a strong rally in price, like we've seen in Nvidia and the semiconductor industry, or like we saw, for example, in energy stocks throughout 2022, I think it's very normal when you're looking at trailing and forward to see that big variance in the numbers, because essentially they're both factoring in the same current price, but they're factoring in very different periods when looking at earnings, whether it's past earnings or forward earnings expectations.
Thanks for watching. Remember that the price of stocks and shares may vary depending on changing market conditions. You can read more of our analysis by clicking on the links in the description box below. And don't forget to subscribe to stay alerted to our regular chart analysis videos each week and other explainers on big financial topics of the day.